Over the last 24 months, retail investors have been caught in an endless cycle of distraction. Many chased the dream of finding the next big meme coin or gambled on low-cap projects that promised a miraculous 100x. A handful managed to walk away with profits, but far more ended up losing, and many lost everything. While retail was consumed by short-term hype-driven speculation, something far more significant was quietly unfolding in the background. Institutions were laying their foundations and positioning themselves at the center of the future of finance and cryptocurrency, much like they did 2 decades ago during the rise of early technology and internet stocks.
We believe the next step going forward will be the tokenization of financial assets. Every stock, every bond, every investor, you and I will have our own number, our own identification.
The difference between the retail and institutional mindset is unmistakable. Institutions weren't chasing hype. Their trillions in potential capital demanded assets that could stand the test of time. While retail played in a casino of tokens with no sustainable future, institutions were securing positions in projects aligned with the future of money itself. Because at its core, blockchain technology isn't just some random invention or investment trend, it's a fundamental breakthrough that redefines how value moves across the globe. Compared to traditional finance systems, blockchain offers something dramatically different, which is trustless settlement, unbreakable security, and near instant transfers that spans global borders. It unlocks a new era of decentralization, transparency, and simplicity in how the world sends, receives, and stores money, and this is why institutions want their stake. This shift presents us with a rare opportunity, the ability to generate sustainable long-term returns simply by aligning ourselves with institutional investment interests. By doing so, you aren't just protecting your capital, you're positioning it to capture a share of the trillions of dollars set to flow into crypto over the next 10 to 20 years. A disciplined strategy of accumulation and long-term holding will outperform 99% of the market because while retail liquidity eventually dries up, institutions have pockets that never do. Following their lead means building alongside the most powerful forces shaping the future of finance. And here's the best part. Investing with the so-called smart money isn't overly complicated. The key is understanding where that capital is flowing. At any given time, there are perhaps only 100 projects worldwide that institutions seriously consider allocating to. They don't scatter across every new narrative or hype cycle. They are selective and they focus on fundamentals. To see this clearly, we need to look at the market the same way they do, through the filters institutions use when deciding where to allocate their capital. The first filter they apply is utility. Institutions ask, does this project solve a real problem, and does it offer a product capable of reshaping an industry? Take Ethereum as a prime example. Bitcoin introduced the principle of decentralized, trustless money, but Ethereum expanded on this vision, creating an entire ecosystem of decentralized applications, smart contracts, and programmable finance. This wasn't just an incremental improvement, it completely redefined what blockchain could be, pushing the boundaries of finance and technology alike. If you study Ethereum's long-term chart, its price reflects more than speculation. It represents the sheer scale of its innovation and the undeniable utility it provides to developers, institutions, and users worldwide. That is why utility matters. Ethereum is on track to become a multi-trillion-dollar asset within the next decade, precisely because it stands out as the most significant financial innovation since the dawn of fiat currency itself. The next filter is ensuring the project has a clear and sustainable future. It isn't enough for a token to simply have utility only designed for today's use. It needs a roadmap that demonstrates long-term vision and major upcoming developments. Roadmaps are a direct window into a project's ambition and its technical capacity and whether it can adapt to the evolving needs of the market. Now let's take Ondo Finance as an example of this quality. Ondo is pioneering the tokenization of real-world assets by offering institutional grade access to US Treasury bonds, a product that fundamentally transforms how we interact with traditional investment classes. For the first time, assets that were once limited to a narrow group of investors are being made liquid, transparent, and accessible through blockchain infrastructure. This is a monumental shift that bridges the gap between decentralized finance and the largest, most stable markets in the world, and Ondo isn't stopping there. Its roadmap includes the launch of Ondo Chain, positioning itself as a dedicated ecosystem for real-world asset tokenization, and ultimately evolving into a settlement layer for complex transactions like global real estate. These developments highlight not not only Ondo's innovational importance, but its potential to become a critical pillar in the financial system of tomorrow. Another crucial filter is regulatory alignment. Institutions are risk management machines. They will always prioritize projects that align with current regulations and, more importantly, those preparing for future shifts in the global regulatory landscape. A project that ignores compliance may thrive in the short term, but it will never attract serious long-term institutional capital. Equally important is whether a project can generate significant institutional interest and deliver the kind of infrastructure institutions actually need. The projects most likely to succeed aren't chasing short-term hype. I say this over and over again because they're building the foundation layers for the institutional scale adoption that is heading to crypto. As these institutions grow, they will continuously seek new avenues to deploy capital, and they will demand better, faster, and more efficient alternatives to the outdated systems they've relied on for decades. Projects that provide this institutional operational efficiency, whether through settlement speed, transaction security, or cross-border scalability, are the ones that will capture the main share of the inflowing institutional money. But above all, this requires patience. Patience to hold through the cycles, to ignore short-term noise, to focus on the ultimate trajectory. Because as institutional adoption accelerates, the compounding effect on returns won't just be incremental, it will be exponential. Over time, this parabolic growth will separate fleeting speculation from generational wealth creation. With all this in mind, the final step is identifying the sectors institutions are targeting. Once we know the areas of focus, narrowing down the projects worth buying becomes far simpler. The good news is that it isn't as difficult as it sounds. Institutional capital will not scatter across every coin on the market. It will concentrate, with trillions of dollars set to flow over the next decade into very specific areas, and these include foundational layer 1 blockchains, cross-border payment providers, decentralized finance protocols, and real-world asset platforms. And here's the key insight. This money won't be spread thin. Institutions aren't interested in the endless sea of 30 million plus retail tokens. They are only looking for a small handful. Realistically, no more than the top 100 projects at the current point in time will attract meaningful attention, and within that list, the largest inflows will consolidate into an even smaller group of proven, utility-backed, and regulation-aligned plays. This concentration of capital is what creates generational wealth opportunities. By aligning early with these sectors and projects, retail investors can position themselves ahead of the tidal wave of institutional money, and in a move that is only just beginning to play out.